If you're under 40 and you haven't asked yourself this question yet, you're probably leaving money on the table. And no, I'm not talking about buying crypto. I'm also not talking about avoiding crypto. The biggest investing mistake people are making in 2026 happens before they ever buy their first asset. And chances are you've already made it. Maybe you're sitting on cash right now, watching Bitcoin hit new highs and wondering if you're about to miss out. Or maybe you're doing the opposite. Maybe you're sticking with index funds because they feel safer. But part of you still wonders if you're missing something bigger. And that's where most people get stuck. Not because they lack options, but because they're asking the wrong question. They think the decision is crypto or stocks, but that's not the real decision. Because interestingly, some of the best investors own both, and not for the reasons most people think. Meanwhile, everyone else is online arguing, chasing headlines, following influencers, and reacting to whatever asset is moving that month. And that's usually where things go wrong. Because here's the real risk. You play it too safe and miss opportunity. Or you chase returns and hurt yourself financially. I've seen both happen, but here's what almost nobody talks about. The real answer depends on one number that most investors never calculate, and it matters more than your age, income, or risk tolerance. By the end of this video, you'll understand that number and how it changes everything. Welcome to Gray Finance. I'm Gray. I believe good financial decisions aren't about luck. They're about understanding the numbers behind them. And honestly, most people never really see those numbers. From investing, crypto, housing, taxes, retirement, and personal finance, we follow the numbers, not the hype. So let's get into it. The reason crypto feels so attractive is actually simple. It speaks directly to a financial pressure most people feel today. Let's be honest, if you're earning $50,000 or $60,000 a year in 2026, traditional investing feels slow. You invest a little, you wait, you get normal returns, and you repeat that for years. Meanwhile, everything around you gets more expensive. Rent rises, homes feel out of reach, retirement feels further away. And it starts to feel like you're running, but not really moving forward. Then crypto enters the picture, and it tells a very different story. What if you didn't have to wait 20 or 30 years? What if one opportunity could change things faster? What if you're already late? That feeling is powerful, but it's not greed. It's pressure. It's the thought of, am I ever going to catch up? Crypto doesn't just sell returns, it sells hope. And that's why intelligent people get interested. Not because they're reckless, but because the problem feels real. And yes, crypto has had huge returns in some cases. That gets attention fast, but that's where the psychological trap starts. Because investing is not just numbers, it's emotion. When prices rise, people feel pressure to enter, not because they'll understand it, but because they don't want to miss out. That's FOMO, and it influences decisions more than people admit. The problem is, emotions usually don't improve decisions. People buy when things are high and sell when things fall, which is usually the opposite of what works long term. Now, none of this means crypto is useless. It clearly isn't. But the real question is not, can crypto make money? It can. The real question is, does it fit the problem you actually have? And that brings us back to something deeper. Now, let's talk about stocks. And here's something most people miss. Stocks feel boring because they are designed for patience. Most people want excitement, fast results, big changes, something to talk about. But the stock market doesn't usually give that. Instead, it gives slow progress, quiet growth, year after year, and that feels underwhelming, especially when social media shows people getting rich fast. So, stocks create their own trap. Crypto's trap is emotion, stocks' trap is impatience. People start investing, nothing dramatic happens, and they slowly lose interest. A few months pass, maybe a year, and they wonder if it's even working. That's usually when people quit, right before long term compounding starts to matter, because the hardest part of investing isn't understanding it. So, what's the number? It's simple. How long do you actually need this money? That's it. Not income, not age, not risk tolerance quizzes, just time. Because once you know your time horizon, everything becomes clearer. If you need the money in 2 to 5 years, risk becomes dangerous. Because losses don't just affect investments, they affect real life decisions. But if your time horizon is 20 to 30 years, short term volatility matters less. Time starts working in your favor. That's why two smart people can choose differently from the same investment. Not because one is right, but because their timelines are different. One needs safety soon, the other needs growth later. So the real question is not crypto or stocks. It's when do I need this money? But there's one more thing most people ignore: your financial foundation. Before investing, some things matter more than returns. High interest debt can hold you back more than any investment helps you. No emergency fund means one surprise expense can force bad decisions. And investing money you need next month isn't investing at all. It's pressure. So smart investors don't start with assets, they start with stability. Then they invest based on time and goals. And once you understand that, the debate stops being emotional because both can exist. The question becomes, what am I trying to achieve and how much time do I have? It's waiting for it. Stocks don't make people rich quickly, but they allow consistent wealth building over long periods. Not exciting, but effective. Most successful investors are not constantly finding new opportunities. They simply stay invested longer than others. While others jump between trends, they stay patient. And over time, that patience compounds, not just financially, but emotionally too, because they become less reactive, less impulsive, less likely to restart every time markets move. Now, stocks are not perfect. Markets fall, recessions happen, portfolios go down, just like crypto sometimes outperforms, but they solve different problems. Crypto rewards speed, stocks reward patience, and that leads to something deeper. Look, I'm not saying crypto is bad, and I'm not saying it can't work, but most people are solving the wrong problem. They think they're choosing between assets, when in reality, they're learning how they behave under pressure. Same market, same opportunity, different outcomes, because some people do well in volatility and some people don't. And the difference is rarely knowledge, it's behavior. Everyone thinks they're disciplined until money starts moving against them. That's when theory disappears. So the real question is not, what should I invest in? It's, how do I behave when I'm losing money? Not in theory, but in reality. When numbers turn red and emotions get louder than logic. Do you panic? Do you exit early? Do you chase recovery? Or do you stay steady? That's the real test. Do you have savings that protect you from the emotional decisions? Do you understand what you own? And does your risk level actually match your behavior? Because crypto tests discipline fast, and stocks test patience slowly. Both reveal something about you. So this isn't really about better or worse. It's about which version of you is making the decision, the calm one or the reactive one. Because one survives volatility and the other doesn't. So yes, investing can work, but only if it fits your behavior, not just your expectations. And here's what most people realize too late: it wasn't the market that broke them, it was how they reacted to it. So don't ask, crypto or stocks. Ask, can I survive my own decisions when things go wrong? because once you know that, everything else becomes simple. And in the next video, we'll build on this idea and break down how real investors structure everything so emotions don't control their money.